Warren Buffett once said that reading one specific book at the age of 19 changed his entire life. That book is The Intelligent Investor by Benjamin Graham. Now, most people hear investing book and think of dry math and boring charts, but this is actually a manual on how to keep your head while everyone else is losing theirs. If you've ever felt like the stock market is just a giant casino, these 5 takeaways are going to completely flip your perspective. Takeaway number 1. The moody roommate. Imagine you own a small business with a guy named Mr. Market. Every single morning, he knocks on your door and shouts a price at which he's willing to buy your half of the business or sell you his. The catch? Mr. Market is borderline bipolar. One day he's manic and optimistic, quoting you a price that's sky high. The next day, he's miserable and terrified, offering to sell you his share for pennies because he thinks the world is ending. The mistake most people make is thinking Mr. Market is a genius. They see prices drop, panic, and sell because they think he knows something they don't. But Graham's core lesson is that Mr. Market isn't there to teach you. He is there to serve you. You don't have to listen to him. In fact, the smartest investors wait for him to have a total meltdown so they can buy his shares on the cheap. Your job isn't to predict the price. It's to know the value of what you own and wait for the market to get the math wrong. Takeaway number 2. Investing versus gambling. There is a massive difference between an investor and a speculator, and if you don't know which one you are, you're probably the person getting liquidated. Investing is a calculated operation that focuses on the safety of your money and a steady, reliable return. Speculating is just a fancy word for hoping. If you're buying a stock because you did the homework, understand the business, and see a path to long-term growth, you're investing. But if you're buying because you saw a screenshot on Twitter or a to-the-moon meme, you're gambling. Graham's golden rule is to treat a stock like a piece of a real-world business, because that's exactly what it is. If you wouldn't feel comfortable owning that business for 5 years while the stock exchange was closed down, you shouldn't own it for 5 minutes. By the way, if you're finding this helpful so far, do me a huge favor. Smash that like button and hit subscribe. It tells the algorithm that you're serious about building real wealth, and it helps me keep making these for you. Let's get back to it. Takeaway number 3. The bridge builder's secret. This is called the margin of safety. Think about it like this. If you're an engineer building a bridge for trucks that weigh 10,000 pounds, you don't build a bridge that collapses at 10,001. You build it to hold 30,000. That extra space is your safety net for when things go wrong. And in the market, things always go wrong. Never pay full price for a stock. If you think a company is worth $50, you wait for a moment of chaos to buy it at 35. That gap is your protection. It means even if the company has a bad year or the economy slows down, you're still safe because you bought in with a massive discount. Smart investing isn't about being right 100% of the time. It's about making sure that even when you're wrong, you don't go broke. Takeaway number 4. Pick your lane. Graham says there are only 2 ways to play this game: the defensive route or the enterprising route. The defensive investor knows they don't have the time to read 500-page financial reports, so they stay humble. They buy broad index funds, they automate their savings, and they let the power of compounding do the work while they sleep. The enterprising investor is a predator. They spend their weekends hunting for undervalued stocks and analyzing balance sheets. Both paths work, but most people fail because they try to be enterprising with a defensive work ethic. They try to pick winning stocks based on 30-second clips they saw online. Pick your lane. If you aren't going to put in the hours, stay defensive. It's better to get rich slowly than to go broke trying to be a hero. Takeaway number 5. The war for your mind. The final and most important lesson is that your own psychology is your biggest enemy. Intelligence doesn't make you a great investor. Discipline does. We are biologically hardwired to feel fear when our account turns red and greed when it's green. The market is literally a machine designed to transfer money from the people who can't control their emotions to the people who can. When everyone else is panicking and selling their shares at a loss, that is exactly when you should be calm. When everyone is flexing their gains and buying into the hype, that's when you should be worried. The secret isn't having a higher IQ. It's having a higher level of emotional control. Stick to your plan, ignore the noise, and stop checking your portfolio every 5 minutes. If you can master your own head, the money will follow. If you enjoyed this breakdown, drop a comment below and let me know which of these 5 takeaways hit home for you. Should I do a part 2 on how to actually calculate that margin of safety? Let me know, and I'll see you in the next video.